It's Friday, January 30th, 2026, and silver just dropped from $121 to $95 in a blink. Gold got hit too, sliding from $5,600 to $4,950. If your pulse just spiked, pause and stay with me, because the headline explanation doesn't fit the evidence. The numbers on your screen are shouting one thing while the real-world market is doing the opposite. Here's the weird part. The price is crashing, yet people can't find physical silver to buy. When a market is healthy, lower prices bring out sellers and fill shelves. So why are shelves going empty? Welcome back to the Hidden Economy, where we follow the plumbing, not the pundits. If you want these breakdowns every week, hit like and subscribe right now, because the next move won't wait for you to catch up. All right, let's unpack what happened today and why it matters more than a red candle. Because this isn't just a price drop, it's a stress test. Over the last few sessions, silver got smacked down more than 20%, and it happened fast. Moves like that usually come with a flood of available metal and discount deals everywhere. But instead, the conversation you're hearing from buyers is, I'll pay, just show me inventory. That disconnect is the clue, and it points to a split market that most people never learn exists. Silver doesn't trade in one market, it trades in two, and right now those two markets are arguing in public. Market number one is the paper arena: futures, options, swaps, and products that track silver without moving a single bar. It's massive, fast, and dominated by institutions that trade leverage, not metal. Market number two is the physical lane: coins, bars, kilo bricks, industrial deliveries, and vault withdrawals that you can actually weigh. It's smaller, slower, and it's the only place where out of stock is a real phrase. On a normal day, the paper price acts like the scoreboard and physical follows it with a modest premium. But when the pipeline jams, the scoreboard keeps changing while the warehouse runs dry. That's what a paper-physical disconnect looks like. Spot says $95, but the real ask is, can you even get delivery? And when the answer becomes not reliably, the posted price stops being a complete signal. So how can the paper price drop hard while physical gets tighter? Because paper silver is built on contracts, and contracts can be created and closed in huge size without any metal changing hands. A futures contract is a promise with a calendar attached, not a bar sitting in a box. Most traders never intend to take delivery. They're managing exposure, hedging, or just trading momentum. When volatility spikes, brokers raise margin requirements and weaker positions get forced out. That creates mechanical selling. It's not new information. It's you need cash right now. Add end-of-month positioning, option-related hedging, and algorithms that chase liquidity, and you get a fast air pocket move. The paper market can drop $20 before a refinery can even cut a single blank for a coin. Physical, on the other hand, is constrained by fabrication and logistics. Even if raw silver exists somewhere, turning it into small bars and coins takes time, and shipping it takes longer. That's why you can see a crash on a chart and still see premiums rise at the counter. The chart is trading claims. The counter is trading objects. Now let's talk evidence, because this isn't a vibes story. When multiple major mints start using words like pause, allocation, and backlog, that's the supply chain talking. Start with the Perth Mint in Australia, one of the most recognized names in bullion. Reports from wholesalers say Perth temporarily halted new wholesale orders on a key silver coin to clear outstanding demand. The reason given wasn't falling interest. It was surging demand in a queue they needed time to process. When a producer tells distributors to wait weeks, that's not marketing, that's capacity. And notice the timing. Messages like that hit before the deepest part of the price drop, meaning the physical strain was already there while the screen price still looked calm. Next, look at the US Mint situation, where temporarily unavailable has become a recurring label on silver products. When spot moves fast, retail pricing can't keep up, and mints often pause to reprice and manage inventory. That pause isn't proof of shortage by itself, but combined with everything else, it matters, especially when popular products show delays and subscriptions sell out early. Then there's the UK's Royal Mint, another giant in the space with reports of silver bars and large formats going out of stock. If a basic kilo bar disappears across multiple regions, it's not just collector demand. This is where people get tripped up. Out of stock can be a manufacturing bottleneck, not absolute global depletion. But when several sovereign mints hit bottlenecks at the same time, the system is clearly under pressure. Now zoom to India, one of the world's biggest silver-consuming markets. When dealers delay or cancel deliveries after taking orders, that's a distribution failure, and it often happens when replacement inventory can't be sourced at the old price. In plain terms, a shop sells what it thinks it can restock tomorrow. If tomorrow's restock is uncertain or far more expensive, the shop stops promising delivery. Retail channels are flashing the same signal, and even big box sellers have noticed. When a warehouse retailer adds purchase limits on bullion, it's usually because supply is tight and demand is surging. And remember, limits are a decision, not an accident. Companies that love volume don't cap sales unless the pipeline behind them can't replenish quickly. So the picture forming is simple. Paper trading is pushing the screen price down while real-world demand is pulling inventory off shelves. That can happen, but it can't happen forever. To see how fast physical can move, look at exchange warehouses where metal is tracked and reported. When large withdrawals show up, it means someone didn't just buy exposure, they took possession. In China, the Shanghai Futures Exchange publishes vault statistics that traders watch closely. When you see sizable daily drawdowns, it suggests strong delivery demand or inventory shifting out of visible stock. If withdrawals accelerate, the headline price crash starts to look less like a collapse and more like a transfer. Paper changes hands in New York. Metal changes location in Asia. Here's another detail that matters. Silver is both a money metal and an industrial ingredient. Solar manufacturing, electronics, medical tech, and EV supply chains don't care about chart patterns. They care about availability. When industrial users get nervous, they don't time the dip, they lock contracts and build buffers. That behavior can drain inventory quietly, even while speculators are selling paper. Now, you might be asking, if physical is tight, why didn't price rocket instead of crash? Because the benchmark price is still set primarily in the paper arena, where leverage can overwhelm reality in the short run. It's like setting the price of water based on betting slips, while the reservoir level keeps dropping. The betting market can swing wildly day to day, even if the reservoir trend is one way. And end-of-month Fridays are notorious for violent moves. Options get rolled, books get squared, and risk managers demand tighter exposure. That can create a perfect storm for sudden downside, regardless of physical demand. So the core question becomes, which market is giving you the better signal right now? The screen that can be moved by leveraged flows, or the supply chain that's visibly straining under real orders? To answer that, we need to follow the selling pressure, who sold, when they sold, and why it clustered at specific hours. Because time of day patterns often reveal intent and structure. Multiple traders have noted the heaviest selling tends to hit during US trading hours, when COMEX liquidity is deepest. Outside those hours, the market often stabilizes, and sometimes bids return in Asia. That doesn't automatically mean a grand plot, but it does mean the price is being set where paper volume is highest. And when price is set by paper volume, physical can get dragged around instead of leading. Now let's go one layer deeper. Because the next pieces, lease rates, delivery mechanics, and inventories, explain why this gap can widen fast. Stay with me, because this is where most viewers start seeing the pattern. Block 2. Lease rates are basically the interest you pay to borrow physical silver for a short period. In calm markets, they sit low, but when they spike, it signals that metal is hard to source quickly. When lenders demand high rates, they're telling you one thing: I'll lend, but only if you pay me like there's scarcity risk. That's a different message than a falling spot chart. Another clue is the spread between near-term and future prices, known as contango or backwardation. When the near-term price becomes unusually expensive relative to later months, it can hint at immediate tightness. And this is where COMEX mechanics matter, because delivery isn't the same as a truck shows up at your house. Delivery often means a warehouse receipt changes ownership inside an approved vault. Even then, there are layers. Eligible inventory can meet standards but isn't committed to delivery, while registered inventory is tagged for settlement. Those categories can shift quickly when owners reclassify metal, so a casual headline like COMEX has plenty can be misleading. What matters is what portion is actually available for delivery at the posted price, not what exists somewhere in the building. When volatility hits, another mechanism kicks in: exchange for physical, or EFP, where positions can be shifted between futures and other venues. It's plumbing, and when plumbing strains, the market can look calm until it suddenly doesn't. Now, circle back to what you felt today. Fear from the chart and confusion from the shortage. That emotional whiplash is exactly why big money loves volatile weeks like this. If you're watching candles, you're watching the battlefield. If you're watching inventory and premiums, you're watching the supply line, and wars are won on supply lines. Here's what stands out. Much of the sharp selling pressure tends to arrive when New York opens and liquidity is thick. That's when banks, funds, and hedgers can move size without slipping the market too far. Sometimes that selling is risk reduction. Sometimes it's margin-driven liquidation, and sometimes it's producers hedging future output. Whatever the motive, the effect is the same. The paper price gets heavy fast. Meanwhile, buyers outside that paper hub often treat dips as shopping events. If you're a refinery, a solar manufacturer, or a large allocator, you don't wait for a perfect bottom. You buy when supply is available. That's why you can see stability overseas even when US hours look brutal. The price discovery window is paper-dominated, but the physical accumulation window can be global. Now, let's add one more ingredient. Silver is a deficit metal in many recent years, meaning total demand has outpaced new supply. The deficit doesn't break things overnight. It slowly drains stockpiles until one shock exposes the weakness. Mining output isn't a faucet you can crank up next week because new projects take years and most silver comes as a byproduct of other metals. So even if prices jump, supply responds with a lag. At the same time, industrial demand is not optional for many sectors. Solar panels, power electronics, data centers, medical equipment, and high-end soldering all consume silver because it's hard to substitute at scale. Recycling helps, but it's not a magic refill, especially when products are dispersed and recovery rates are limited. A smartphone doesn't return its silver to the market on a schedule that matches investor panic. So the system relies on above-ground inventories, vault stock, dealer stock, mint blanks, and industrial buffers. When those buffers get drawn down for long enough, the market becomes fragile. Fragile markets don't break at the top. They break on the way down when everyone tries to buy at once. A drop from $121 to $95 can be the spark that pulls forward months of demand into a few days. That's why your intuition says discount equals more supply. But reality says discount equals a rush on the remaining inventory. The lower the screen goes, the faster the shelves can empty. So what should you do with this information without getting emotional? First, separate the tool from the asset. Paper vehicles are tools, physical metal is the asset, and they don't behave the same in a stress event. If you hold physical, don't let a benchmark price bully you into dumping something that is clearly hard to source. A better question is, what would it cost to replace this tomorrow? If you hold paper exposure, ETFs, futures, or unallocated accounts, read the fine print like it matters, because it does. Ask what happens in extreme volatility, how redemptions work, and what your path to delivery actually is. And if you're trying to buy physical right now, focus on total cost, not just spot. Premiums, shipping, availability, and delivery timelines are the real price. They can change faster than any chart. One more thing. Mints pausing sales doesn't always mean the planet ran out of metal. It often means a bottleneck in blanks, staffing, or hedging capacity, but widespread bottlenecks still signal tightness. When many independent nodes show strain at once, mints, dealers, retailers, and warehouses, that's when you pay attention. Markets can ignore warnings for months, then reprice in a week. This is also why people get trapped by spot is down so you overpaid. If you can't buy at spot, then spot isn't what you paid, and it's not what you can replace at. Now, if you want to navigate the next phase, watch the indicators that can't be faked easily. Watch what gets rationed, what gets delayed, and what gets pulled out of visible inventories. Here are the 3 signals I'm tracking next, and you can track them too without being a pro trader. They're simple, they're public, and they cut through the noise. Number 1, premiums and delivery times. When premiums keep rising, even as spot falls, it means physical demand is absorbing supply faster than it can be rebuilt. Number 2, mint allocations and product pauses. When producers talk about backlogs, allocations, and delayed releases, it signals capacity limits and persistent order flow. Number 3, lease rates and warehouse withdrawals. When borrowing costs jump and inventory drawdowns accelerate, it shows urgency for real metal, not paper exposure. If those 3 keep flashing red while the chart whipsaws, the disconnect is still alive. And if the disconnect is still alive, sudden repricing becomes more likely than a smooth, polite trend. Some viewers will shrug and say, "This is overblown. Markets always normalize." Sure, they often do, but normalization requires inventory to return, not just a narrative to return. Others will claim everything is planned and scripted by a single actor, and that's not what you need to believe to understand the risk. You only need to accept that leverage can move benchmarks faster than supply chains can respond. The practical takeaway is this: don't let one venue's price action erase what multiple venues are signaling. When several independent sources say tight, treat that as information, not hype. Also remember that violent drops create forced sellers, and forced sellers create opportunity for patient buyers. That's how markets transfer assets, from the reactive to the prepared. So zoom out and ask, are we watching a collapse in demand, or are we watching a scramble for positioning as the month ends? The shortage stories suggest the second more than the first. If the paper price keeps falling while the physical price keeps rising, the market is essentially running 2 price tags at once. That's unstable, and unstable systems eventually choose one tag. Which tag wins depends on whether real metal remains available to satisfy paper claims at scale. If delivery pressure rises and visible inventory falls, paper pricing has less room to ignore reality. Right now, you're watching a magic trick where the screen says cheaper, while the checkout line says sold out. Once you notice that, you stop reacting like a spectator and start thinking like a strategist. So don't get shaken out by noise, and don't chase blindly either. Focus on availability, terms, and risk. If you want to follow up the moment these indicators shift, you'll want to be plugged in. Hit subscribe and turn on notifications so you don't miss the next update when the market moves again. And if this breakdown helped, tap, Like so, it reaches the people who are staring at the chart and missing the shelves. Now tell me in the comments, do you think the benchmark price will pull physical back into line, or will physical force a new benchmark? I read every comment, and I'll build the next script around what you want covered.